And hi, everybody, welcome to another edition of Your Money Radio. Danny Stewart, Don Vandenbord, live with you whenever you are listening to the sound of our voices or watching us. We are absolutely positively live with you. This is an interesting time in the market. It's the first Friday of August, and normally it would be a slow market, and we'd be struggling for things to talk about, but we don't this week, and which one makes it interesting. But I've got bigger news before we get to gold. Before we get to bonds, which I want to talk about, and nothing kills a show like bonds, but I want to do bonds because the inflation that is, well, that's true. Bonds are so boring, but they're not boring this week because the inflation that's creeping into the economy is real. It's a very big deal. And I want to talk about that because it's going to affect you eventually. It'll affect you right away, but it'll affect stocks eventually. And then I want to get to some misconceptions about the market environment to which we're in. But before I do any of that, I've got like three things I need to cover. First, Don, what's the t-shirt?
AC/DC.
Nice.
All right.
I think that this was the original one that kicked off the whole concert tee discussion, if I'm not mistaken.
Oh, it is? Did you travel? How many t-shirts did you travel with?
Not many. Like 5, but luckily everybody has a washer dryer up here.
No, I meant concert t-shirts, not just how many concert t-shirts. I didn't know if you took.
I think 2 Kiss shirts, an AC/DC shirt, not that many.
Not that many? Well, listen, I've got other than stock news. By the way, we're going to do the Don's 21 over 21. We'll talk about that today. And there'll be a fresh video coming out this weekend for 21 over 21. I've got big food news. So before we do stocks, I want to talk about food. Now, Don, you know I'm a big fan of keto pizza, right?
Yes, you are.
Like almond crust, chicken flour crust pizza. Discovered this week. It's now if you don't have a Marco's, I'll tell you where else you can get this. This is from Marco's, and I don't know how many other places do this, whether you have a local place that does this or a chain that does this. These are just pizza bowls, and they are absolutely 100% fan-freaking-tastic. Like it's 3 thumbs up. Like if you got a third thumb, raise it because it's that good. And they're only like $8. And so
so it's basically a bunch of pizza toppings and cheese and sauce and no dough.
Oh, don't discount it. Like basically, yes, but don't make it sound so simple. The way the flavors are melded, Don.
Don't they just call that lasagna?
I think that is lasagna, Dan.
No, lasagna's got noodles. Danny, lasagna's got noodles. By the way,
you're
Tanya
right.
Okay,
Tanya
so
makes,
it's spaghetti sauce.
Oh, it's fantastic. It is so good. Like so good. I've had it 2 nights this week. And I get the meat lovers. And then I get it with banana peppers, and I think we ordered it with their garlic butter sauce, but it is awesome.
I think the shock to the audience is that the off-topic news is about food and not about cards.
That's coming. Don't fret.
I had a feeling.
That's coming. Yeah, it's coming. And then, but I think you can get these at Papa Murphy's. Now, most places have a Papa Murphy's, and I'm not going to lie to you. Hey, Don, Papa Murphy's is a stock. Can you tell me what the ticker is? I forgot it. It's a junk stock. Like it crashed. I want to say years ago, but like only maybe within the last 24 months. And I say that because Papa Murphy's, if you're not familiar, is a take and bake pizza restaurant. And look, if anybody in our audience owns a Papa Murphy's franchise, this is not directed towards you.
But not showing in Market Smith, so it must be a penny stock.
I wonder if they got bought out. Anyway, Papa Murphy's is take and bake. And so like literally you go into the shop, you make the pizza, or like Subway, like they make the pizza, you tell them what you want on it, and then you take it home. And for years I'm going, what the hell is the attraction to this? But the Papa Murphy's where I live has been in business the entire time I moved to this town. And I guess there's a bunch of people who do not think like me. But I will tell you, I am going into my local Papa Murphy's this weekend and getting a pizza bowl, just like you see there. Even though it says Marco's, they've got the same thing. I'm going to go try both. I'm going to do a compare and contrast. Danny, why you see you just nothing to contribute here?
No, that sounds great. Let me ask you a question about the Marcos in your, because it's family owned. We've got one up by us, and it's right next to like the family video rental. Is that?
Oh,
is
I know
it
the
next
family
to,
video. Yeah.
Yeah. Is it right next to the family video, the Marcos?
No. This one's right by my house, like 5 minutes. They have sprung up like bunnies doing it. Like
Right.
they had a big franchising spree here in Dallas, and now they're all over the place.
Right.
Well worth the money though. The $8 that you're going to spend
food.
on
Yeah,
there.
it's good. Yeah.
Yeah, and I don't, because I don't do normal pizza crust. What's that, Don?
Papa Murphy's used to be ticker FRSH, and it was acquired and taken private for $6.45 a share, or $190 million in April of 2019.
Oh yeah, I won't be able to pull this up. That's a bummer, because that thing was that getting bought out was their only avenue. Like, because every time they'd report a quarterly earnings, it was just a disaster. It was not a good thing. So anyway, Don, I say we do the baseball cards right now, because I'm excited. Don, you got to see this. Like, let me see if I can hold it up to my phone. Hold my phone up to the camera, because look, I'm going to show you a bunch of cards. Look at this card. This is a short print. This is from Series 2 Topps. Let me see. Which way do I have to swipe it? That's Luis Robert. I think it's Luis Robert. Short print. Look, he's a rookie. Look at the price of these cards, Don. This is my favorite card. That's Andrew McCutchen, Philadelphia Phillies throwback uniforms from the 1970s.
The throwback unis are cool.
Oh, this is my favorite card. And Don, because I can read trends, I bought like 3 boxes of these when people were down on Series 2 and baseball wasn't looking like it was coming back. I saw that Andrew McCutchen card. I could sell these for triple what I bought them, but I'm not going to. I'm going to open every single pack.
I did my, when I was in New Jersey at my sister's house, my brother-in-law is a huge Phillies fan, and they had the cardboard cutouts behind the home plate, and they had the game on, and the Philly fanatic interacting with the cardboard cutouts is hilarious.
It's like
the fanatic is one of the best mascots.
Yeah. Interacting with a cardboard cutout, Don, is like what you and I do with Danny every week on this show.
That's true.
Even Danny had a laugh at that.
That was pretty good too.
You know, you can't spell fanatic. It's with a P, not an F. Anyway, so look, there are a bunch of you out in our listening audience that are really fearful of what's happening here with gold, and gold's down 1.5% today. But you've seen this tremendous run in gold, and it's got you spooked, and you're looking for, and you see silver's doing same kind of pullback today, and it's got you spooked, and you're not. I got to get this Marcos thing off of there, or I'll just keep thinking about food. And so it's got you scared of taking action in the market, or taking positions, or participating in the market. And Don said it succinctly on our morning phone call this morning. I'll let Don say what you told us. Tell the people what you told us on the phone today.
That people think that stocks in gold and or silver can't go up together, and that's just not true.
And I've been having that discussion, but I didn't say it as eloquently as Don is, and that we're not bearish in the shop, but we're always waiting to enact our sell discipline, meaning that we're looking for the signals that make us want to enact a discipline that says, hey, it might be smart to take profits. It's probability based. Like our investing style here is 70% fundamental, 30% technical, and it's based on a lot of probability. And so when you look at this chart, let me just get this chart refreshed here a little bit. So when you look at this chart of silver, is the area to enter silver here, or do you want to wait for maybe the opportunity to get this wasn't a deep pullback, but do you want to wait for a pullback maybe to one of the means here, one of the ATR levels, or the mean? And if you don't know what I'm talking about, this is an average true range chart. It's based on it. You can see it down here on your lower left-hand side of your screen. And if everything always reverts back to the mean being for us the 21 period moving average, if you start getting 1, 2, or 3 levels above the mean, you can see scientifically, you can see factually how stretched you truly are. And price does snap back. And so somebody bought silver today at 29.91. Somebody did that. It wasn't us. But that's a high risk entry point. You don't want that entry point. You don't want that entry point. What you want is you want to come down somewhere, maybe where it pulls back. It doesn't have to pull all the way back to the mean. But that, what I just described to you, is not just for silver or for gold. It's for, say, the indices. And so when I'm looking at the indices here aren't stretched. I mean, you can see the S&Ps are at the second ATR, but they can work their way up in this market environment all the way up to that third ATR. And that's when you would say they're stretched on. Can you give them the stats about third ATR in the 21 period moving average, how they coincide? Please?
Well, with the indexes, the +3 ATR is usually about 6%, 5 to 6% above the 21-day exponential moving average, and that's considered pretty stretched. And normally you go sideways or pull back at that point. Going sideways obviously is the best thing. That just allows the average to catch up to the price.
And
I got to interrupt for a second. I got a bad thunder and lightning storm here, so if I get knocked off, you'll know why if the power blinks. And also, I just got like 10 alerts in leaders breaking below recent support. The indexes are at the low. The NASDAQ 100 is at the low of the day. I just got downside alerts for Roku, for Net, for let's see what else. DocuSign, Zoom. What I do is I have like bracket alerts set, and maybe this would be a good topic for a lunch and learn. And if it breaks below a recent support area, my alert goes off. That doesn't necessarily mean buy or sell. It's just getting my attention to take a look at what's going on. But I'm looking at a lot of red suddenly on the screens, and we've also seen a bunch of the SaaS/cloud stocks breaking down on earnings over the last couple of days. Datadog, DT, Fastly, obviously, that's not necessarily, it's more edge computing network than it is software, but something to keep an eye on. Twilio hasn't been able to recover, and they had a secondary. In fact, I sold that today. I know I just hijacked the show, but I just wanted to
no, that's all right. We can
alert
that's
at 11:55 Eastern time that I got a bunch of alerts, and normally when I get them, there's something going on in the market.
So oftentimes, what you'll see on a Friday, so it's Friday, you know when we're taping the show. So here's Danny and I are in the Central Time Zone, Don's in the Eastern Time Zone, and so what you'll get is we're the only markets open. It's a Friday. Europe closes at 10:30 Central. We are the only market now in the world that is open. And so what Don's saying is that he got some downside alerts. And let's pull up a chart here. Let's go over here. I'll pull up this daily chart. And then we'll start taking a look at the S&Ps, because what you'll see is you're going to get algorithms starting to run some stocks. Now, it could lead to a bigger sell. It doesn't matter what's happening in the least. It doesn't, as my computer freezes up here. It doesn't matter what's happening.
The indexes are fine, really, which you had been mentioning, but today value is far outperforming growth slash momentum.
And so here you've got the S&Ps, which are, here's the low right before the cash session open, before the jobs report comes out. And you can see they're holding their own here. But Don's mentioning a bunch of NASDAQ 100 stocks. So we'll take a look at that real quick. So we'll look at the NQs. And so when I'm looking at the NQs, you can see now they have broken, this is their low. Let me see if this is their low for the overnight session. Yeah, that's their low for the overnight session. And so is it time to just run to the hills and sell? You can see the NASDAQ's down 0.8%. and I come to say the Russell futures, and Don mentions value, you're up 0.7%. I look at the Dow, and the Dow is only down 0.4%. The Russell's leading. That's a big deal. And so we've been talking this week, Don and I, in the videos about how to be in the recovery stocks, because what you'll hear people say is, and it's a generic term that's gotten picked up all over the industry. You want a barbell effect. You want some of the SaaS stocks, this software as a service stocks that Don mentioned, the cloud plays. You want some of the Amazons, the tech darlings of this COVID era. But you know, when you get the opportunity to add small caps like the Russell, or you get an opportunity to add some Dow stocks, you got to do that too. And for me, and for Don, the easiest way to do that is via the YM, is via the indices. And so we picked up DDM, which is a double Dow, on, I believe, July 20th. And if I come here, where is July 20th? Let me zoom in here. So here's, it's just easier on the Dow to show you the futures trade. So when I'm looking here at the Dow, 720, right in here. And so this brings up two huge points. One, we cleared, prior to that, we cleared the 200-day moving average. We had that period of consolidation, and now away it goes. And so even though it pulled back here for a number of days, it still held the 200 and still held the 21. So you're looking at the 200 and you're looking at the 21. And so our setup was still intact, but how we bought, and this coincides with what I was talking about, where people are spooked by the metals and they're looking for any reason to give them excuse not to take a step into the markets, and they're looking for any reason to sell stocks. How you buy is so critical. We bought this consolidation and it still pulled back, but because we didn't buy something extended like up here, like we showed you that silver chart just a few seconds ago, how you buy is so critical here. And then size that you buy, 5% positions, a 10% position that you can trim, or if you're concerned about the volatility, 2.5% position with wider stops gets the job done every time of a 5% position. So widen your stops and control your size, and you're going to be just fine. You'll be able to participate and you won't get shaken out. But so many people have such tight stops that they get run. And what Don just described, he's got a bunch of downside alerts. What Don just described was a liquidity break. And so here's the daily chart of the NASDAQ. And so the NASDAQ isn't even back to the 5, but it's down 0.7%. It would make sense to come down and maybe test the 5. Will it do it today? I don't know. But what are algorithms going to do now that the markets are closed? They're going to give you these liquidity breaks. And if I took this to a 15-minute chart, let's do a 30-minute chart, you'll see another liquidity break that happened on Tuesday or Wednesday. So here's Tuesday. That's 1:30 in the morning. Let me get, there was a pretty substantial, maybe it was Wednesday. Oh, was it Thursday? There was a liquidity break this week. Maybe it is this one here that took place, but you're still higher for the week. And so where are you at in time and space? You can easily measure this on an average true range chart. Come back to the daily and say, are you extended? Well, at the 2 ATR, you could argue, as I try to zoom in here, you could argue that, yeah, that's a level that we saw pull back before. But the 3rd ATR is typically where you can clearly see over time immemorial, if I can get there, that's where you are extended. And so, well, that chart really got away from me there. Let me just unzoom this real quick. That time immemorial, the 3rd ATR, is where you want to consider taking a little off the table. Now, look, this had this monstrous run in December coming into 2020. But even there, you got to pull back to the mean right there. And then you could say, well, you know, Tim, if you would have sold at the 3rd ATR, you missed all that uptrend. Well, you can trail your stop, but you gave all that move up here to only get close to the 3rd ATR again to give it, you know, of course, you know what happened in March. So back to what we were talking about with silver, gold, spooking people and preventing people from getting in, you have to have a plan. You have to have a plan for buying, and you have to have a plan for selling. And so we bought the RTY. So we bought a double. It's UWM, right, Don?
Yes, UWM.
UWM. We bought UWM on July 20th, July 23rd. 20th or 23rd? What date was it?
It was the 23rd was UWM. The 20th was DDM.
There you go. So here's the 23rd. It's not even, it doesn't even get back to the mean. But what we did, let me zoom in on this. What we did, so here is the 20th, right here. Here's the mean. It doesn't, we bought the consolidation. It does what we think it's going to do, pulls back a little bit, even pulls back to the mean, and then takes off. So even following our own rules a little bit better, like everything always pulls back to the mean. It doesn't matter what it is, where it is. And when I say pullback, you could get that all these ATR lines to move up and they can come meet price. That's fine too. It doesn't have to be some vicious sell-off, but what's happening in this environment is so many are missing some really good stocks, or they're missing an opportunity to participate in markets because of fear. And now the metals have I think the metals have exacerbated that. But it's understandable. Daniel, what you got?
Well, so I wanted to add kind of tag team on what you were saying. So kind of another way of what Tim's saying is if you buy 3 ATRs above the mean, and Don succinctly said that that's about 6% or so above kind of the average price you're buying. And so now if it does pull back, now you quickly got a 6% loss, and you're getting very close, if you hadn't already hit your stop loss, where you're going to get stopped out, and you end up not being able to hold the position. So if you buy at the mean, or maybe 1 ATR above the mean, it makes it a lot easier to hold through those times. And if you get a pullback, it's usually only going to be 2 or 3%, and then it can take off. So number one, you don't overtrade. You don't get wiggled out of good trades that you thought were good. It just improves your probabilities for entry. Your entry is much better timing on the entry.
Yeah,
it's very possible though that if something is moving quickly, you won't get that pullback to the 21. Something that's exceedingly strong, like Livongo on the way up, like Fastly on the way up. They just never got there. And something that's doing that now is the chart you just showed, silver. I did a deep dive into silver from 2010 when it went on its last
to 50
run. Yeah, when it went from, it started out with on 825 of 2010. There was a gap. It was trading at 1854, and it topped at right below 50 on in late April, early May of 2011. It was up over 150. It was up 150%. So silver could have a very long way to go. I know people are saying it's extended, but the best we've been able to get is a pullback to the 8 EMA last week, which I stared at, didn't buy, and am kicking myself, quite obviously. 7:30, it pulled back and touched the 8. Hasn't gotten anywhere near the 21 since mid-June.
And that's why I think folks need a combination of tools. And we talk about this. It's never one piece of information in a vacuum.
That's a great point. The big leaders won't give you that pullback. Yep.
Nope. And so here, this purple line's a 5, and this line's an 8. And we talk about it all the time that you're getting pulled back. It's riding the rail of the 8. When you're in a leader, and silver can be a leader, maybe you take a half position at the 8, and if it were to pull back to the 21, you add the other half, and then it starts getting too close below the 21, you just sell all. But you have to be able, as an individual investor, and that's what we're here to do, is empower you. You have to be able to, one, have that plan in your head before you step into the trade. Like when you're screening for it, you're like, gosh, I know silver is leading, but how can I get into it with the least amount of risk? So the goal is clearly here. You want to, we joke around that the people that call us want to make the most amount of money while taking the least amount of risk. And I say that all the time to people. But what we describe is how you step in with the lowest possible risk entry while trying to maximize the gains that come from it. Buying silver at 29.15 is not the answer. Buying silver, even buying silver here when it was at this wick here around 26.32, that's not the answer. Buying it on a systematic approach. Here's a pullback to the 8. The difference between 26.32 and this 22.50 level is a big percentage difference. And so
can you bring up SLV instead? I would say 98% of the people listening might be in SLV and not in the futures.
Okay.
And
this gappy chart. Go ahead.
The quote, yeah, and that's one thing that you have to deal with. The futures chart, because the 24-hour trading will be much smoother. But ideally, you talked about the half and half approach.
Yes.
7:30, the pullback to the ADMA. Can you zoom in a little bit from? Let's zoom into the breakout above the base, which was on 7:20.
You got it. Let me get that point. You got it right there. Okay, we are there.
So 7:20 was your breakout from a 219-day base. The pivot was 1835. The next day it gapped up, and it gapped up again the following day.
Yep.
The first pullback you got to the ADMA was on 7:30, and right there. Yep. So knowing that silver is extremely strong, waiting for a pullback to the 21 might never come, as we just discussed. So, I mean, this is revisionist history, what I'm talking about, but going back, the ideal way to have played this, and knowing what I know about how silver ran in 2010, 2011, not saying that it's going to do it again, but it could. Half at that pullback to the ADMA, and then the other half at a break above that little 3-day consolidation before the pullback to the ADMA. If you add your other half there, right there, that 3-day consolidation. So that big bar where it broke above it, 4 bars to the right, where we broke above it right there. You can also add your other half on strength, or the pullback to the 21. We employ both techniques, as Tim mentioned earlier. You can't be a one-trick pony, but you have to understand what you're playing with. And silver is, especially with the declining dollar, silver and gold both are acting extremely strong.
And by the way, so one point. So what most people do is they don't have a plan to buy. They kind of think they have a plan to sell, so they just go buy willy-nilly, and then they put a 5% stop on it, and that's just their rule. Well, if you do that, you're going to get stopped out way too much, and you're going to overpay for a lot of things. And your entry, your buy is just as important as your sell.
Yep, every time that's going to happen to you. And the reason why it's going to happen to you is it's the algorithms. All the algorithms are written to every trading book you've ever read, or any. well, that's the truth. Like, that's why the 50. Like when it gets below the 34, like I'll just give an example. Like 2 closes below the 21 is a shift in trend. They're most likely going to take it to the 34, and if it starts closing below the 34, they're going to take it to the 50. And then you'll get some support at the 21, and typically that's why, this is a discussion I wasn't prepared to have today, but I want to have it because it's important. The reason why your stops suck, and the reasons why people's stops suck, is because the computers know everything you're going to do. And so you have to have an idea in your head and have the courage of your convictions to stick to it. That's why Don and I always lead with, what did we sell? And especially, what did we sell for taking, and how did we take, what did we take a loss in anytime we do a trade and it doesn't do what we wanted it to do? It's so important because the consistency of our modeling, meaning we're buying stocks that are typically in the top 10% of the market, fundamentally and technically. We're operating 70-30, 70% fundamental, 30% technical. And so what that allows you to do is be consistent in your actions and how those stocks behave. And if they don't behave in a consistent manner with history, what we know to just get rid of them. Danny might say shit can them, because you have to do that, because if you don't, you're going to get you're going to get pulverized. And so and everyone's had that stock that's GoPro'd them. There's probably some people right now, Don, that are getting fast lead, right? Like, Don knows what fast lead's doing. And Fastly is still a leader, FSLY. Oop, FSLY. But it was at 117 2 days ago. Now it's at 80. And it's only at the 34. It's only at the 34. And I mean, but look at how far it's come from. I mean, they're going to drive this down to the 50. They'll find support at the 50. And then you got to think, well, where does it go from there? It's going to probably flag out, and it needs a reset. It needs a rest. But right now, people are getting Fastly. They got into this thing, Don, late. Somebody bought 117.79. That's not, you don't get this little high tick bubble because they want to just let you know that's where 117.79 is. There's a guy named Bob Smith who bought Fastly because he saw it on, I don't know, Fast Money or Twitter. Somebody was talking it up and he got top ticked, or she got top ticked. And what happens is when you're in a stock like this, especially going into earnings, you have to have rules to hold it, but you're going to get 2 closes below the 21. So if you bought this little base right here off the 21 for a run into earnings and it's not working out, you didn't get that much damage. But when you start buying well off the 21 or well off the 8, this is the kind of price action you're inviting, regardless if it's earnings or not. You're susceptible. And so you have to be able to know where your stop out points are. And so going back to the point, the algorithms are written to every book you've ever read on stops or anything that's published on stops. That's why 2 closes below the 21, they're going to probably drive it to the 34. You get 1 close below the 34, which is the blue line right here. Pink line's the 21, the green line's an 8. So 8, 21, 34, all Fibonacci sequence. They're going to probably drive it down to the 50, which is not Fibo. And so you just got to understand that. And the big, the 50 on this stock is all the way down at 75. Another 5 points.
That was that was a 5-day 48% move going into earnings. So how much more do you think you're going to squeeze out of a 48% move in 5 days after earnings are reported? You get exactly what you deserve if you're being a pig like that. You've got to take some off the table.
I'm going to pause you right there. I think I'm not disagreeing with you. I'm saying I would say to that it attracts momentum traders, that they didn't get the 5-day 48% move. They maybe caught 5 or 10% of it, and they think somebody knows something going into the earnings print. And so they're like, this thing's going to ride to 150.
Yeah. And amateurs think about only the upside and not the downside. And I think that's kind of what we're looking at now.
That's a great quote.
Hey, but everybody's had that dream where you buy the stock or the options, or even sexier like that. Don, they were selling the 150 options for a tremendous amount of money, for hundreds of dollars on 150.
150. Yeah. I'm gonna get a double. I'm gonna get a double in 2 days after I just ran 50%. I'm gonna get another double. That
expected move is already priced into the option.
Yeah.
You're already overpaying for the option.
What you're saying, I don't disagree with. But for the individual investor, they have a show, Don, called Fast Money. It's not called have a plan to slowly over time develop, build your cash. It's called Fast Money. Like that it's just not. People have these dreams of, and I don't begrudge them. It's just the way they're marketed to. I mean, do you think Schwab wants to show you the pit, like all those ridiculous retirement commercials or the Schwabby commercials where they're sitting in, everyone's got a Peloton loft, right? Where it's the most beautiful space in the world. It's looking out over the city and you've got a Peloton bike and all you do is trade stocks all day and you've got that exposed brick wall as an office. It's horseshit.
And you get to flirt with the attractive lady in the who has the exact same setup as you do right across the building.
That's just the irony, Don. That's the whole, that's Hollywood scripting. Come on, Don.
She gives her that little flirty look as she walks into the shower gets off the bike, and what a joke.
She doesn't even smell when she sweats, Don.
No, smells like flowers.
She glistens. And so the beautiful people, they glisten, they glow. And so listen, but Schwab isn't going to tell you that, yeah, like 90% of our traders bought Fastly at 117.79. You know, Liz Saunders isn't going to come on TV and tell you that her traders get top ticked all the time. You know, and that's reality. But they want to present this, if you just give us your money forever. You know, the individual investor, this is why we exist, stock nerds and market lovers, because we're telling you what they won't. If you put your money with Schwab, when you sweat from now on, it's not going to smell. It won't lead to some funky odor. As a matter of fact, if you put your money with Schwab, your house will transform into a beautiful sanctuary where nothing but goodness happens. And it's you that controls this. But they don't give you the plan. They just tell you to buy and hold, and before you know it, you're Fastly because you got in too late. Or what's LVGN? What's LVGO doing, Don?
Well, LBGO, the chart actually still looks good from a standpoint of where it is relative to the moving averages, but it's broken. This will now move in tandem with Teladoc, TDOC.
Oh, let's look. Oh, that's right. It got bought. You know what? I wasn't even thinking that. Oh, look at Teladoc. This has a lot to do with the arbitrage of buying Livongo. But look, somebody bought 253. It's 50 points lower, folks. And
Wall Street did not like that acquisition.
That could be forming a bear flag right there.
Oh yeah, if I took it down to a smaller time frame, absolutely, Daniel. And so,
if you're still in this, you better not break Wednesday's low.
And that's right here. And coincidentally, it coincides with what? Where did you find support? They drove it. They drove it all the way down to the 50-day. And you're like, well, it bounced from the 50-day to the 34, but it got rejected where? At the 21, and now it's back to the 50. You're in the zone of hell, man. Like you think it's not even hell. It's purgatory. It's the worst. Like you think you're getting out of hell.
Zone of hell.
Yeah, the zone of hell. Like Satan looks at you. Satan, he looks at you and he goes, you know what? I'm gonna let you get out of here. And he puts you in purgatory. And what you float up and everything is Marco's pizza bowls, and pizza with regular crust doesn't put weight on you, and you can eat all the chicken nuggets you want. And then you find out, oh my gosh, it's not true. This is purgatory, and you get sent right back to hell.
Let's talk about something positive just for a second.
Well, hold on a second, because when you get to hell, the only bank you have to choose is Wells Fargo. That's the only place you can go. Every ATM, you put your card in, it eats it every freaking time. That's what Wells Fargo does to you. What's positive in your life, Don? You derailed the whole show. I'm a professional broadcaster. I went with it, and I just gave a sermon that helps stock nerds and market lovers across the globe.
Hey, Don's got his AC/DC shirt on.
You're saving lives, Tim. You're saving lives.
I am saving lives and helping people make money.
It's not just a coincidence that Wells Fargo main color is red, is it?
As they say, what does the F stand for in Wells? It isn't Fargo.
Fastly. If you want to get into Fastly, let's talk about a low risk entry.
Let's talk about it.
Now, usually big leaders are buyable the first and second time they pull back to their 50-day moving average. So you indicated we're very close to that. If you look a little bit to the left, the recent lows, there's a cluster of them between 74 and 75. Next week, that 50-day moving average it already is right there. It's at 75. Yeah. That's a really big support area for Fastly. Now you got to if somebody has, a lot of people set their stops right at the 50, that's a mistake. You got to give it 1 to 2% below the 50-day moving average, because everybody that sets their stops right there, the algos will trigger them. It'll immediately drop a percent or two. And if buyers come in there between the 70 and the 75 area, that is as good a low risk entry with a stop below that you will get if you've never played Fastly.
There you go.
And you got to size it appropriately, because you know what your downside is going to be that 70 area.
Yeah. And So I don't really know how we got here other than Don said downside alerts, but I think this was good. I think
Yeah.
this has been helpful.
And Tim, you made the comment a little while ago that, the algos have already read all your books that you've read, so they
Yeah.
know how to do that. Don just mentioned, don't put it right at the 50-day or stop,
Yeah.
because that's where everybody does it. You got to put it a couple points below. Not only that, you don't want to use round numbers like $45 or $50. You want to do 49.93. Even in nickel increments, you want to put them in odd numbers between. But here's the thing. Before Lehman Brothers went bankrupt in the 2008 crisis, they used to actually pay a couple $1 million a year to have a study, to have a research study, and take all the trading the trading strategies taught each year. They would take the top 10, and then they winnow it down to the top 5 most popular that year, whether it's covered calls, whether it's this, whether it's that. And they would have these professional traders for their own accounts trade, because every trading strategy has some kind of weakness, and they would actually trade against that. When they went bankrupt, it was either Goldman or Morgan Stanley, I can't remember which, but one of the Wall Street banks bought that study. So they actually know what the most popular strategies people are trying to do each year, that these guys go around and do these dog and pony shows. They teach these seminars every year around the country, and they know the most popular ones, and they're trading against you. So they're like the house in Vegas, and they let you in just enough to keep you coming back.
And so it takes a tremendous amount of discipline to like this stock Fastly, and you could have. I'm just look. This is any stock. It's not me picking on Fastly. It takes a tremendous amount of patience to just wait for your low risk entry. Now, Don was lamenting that you get this big run. I mean, don't you want to take some off? And so it goes into earnings. And even if you, Danny, don't let me forget this. Danny, just tell me Roku before I do anything else after this chart. Just say Roku, okay? So it takes a tremendous amount of patience to wait for this. You get that 48% move in 5 days. Let's take it to let's come full circle. And I wish I would have thought of this like 10 minutes ago, Don. It would have been really good 10 minutes ago. Just look at where it went, Don. It went to the third ATR. And if you're following something that we do, and just because we're doing it doesn't make it right, it makes it brilliant. And so I'm joking. And so I just want to make sure people are paying attention. Did he just say brilliant? If you're playing a probabilistic mindset, let's pretend that you had a 5% position from the mean, the zone of the mean, and you wrote it up 48% and you're going into earnings. You're like, this could be a big winner for me. I really want to hold it. Why not just sell half and then let the other half, like whatever it's going to do, it does. And you're all you did was come back from this breakout area. That's all you did. So you booked half and you got the other half. And what I just described is what I did with Roku. And so this is Roku, R-O-K-U, Roku into earnings. And so I had a position for a while in Roku, and I was only able to get about 7% out of it. So it was a 5% position. Going into the print, what did I do? I sold half, right? So at a 5, I'm left with half. I got a 7% gain on half, and now the other half pulls back. Where did it pull back to? The mean. And now this is with today. That's now with that 4% move today. That's now green again, and so I'm fine. But this was all the way down to 150, where that 2.5%. At one point was down about 2.5% loss, but I was still overall positive for the trade. Does that make sense what I just said there, Danny? I didn't want to confuse anybody.
Yeah. So the expected move was what we didn't have a 10% gain. We couldn't hold it. So we had about a 7% gain. We were worried. But we liked the chart. So rather than taking the whole thing off, sold half, reduced our risk, and then we can let some ride.
Yeah, and so if someone said, "Well, Tim, is this a low risk entry point in Roku?" I would say green on a day like today is good, but I'd also say that's the mean. And so yeah, if you pull back to the mean and it holds, that's always going to be, for me, a low risk entry point. What you got, Don?
I want to add something to what Dan said because I disagree with it a little bit, or I want to add something to it. You said we like
Sure.
the chart. It's not about a month ago. I was watching an IBD webinar, and Mike Webster, who worked very closely with Bill O'Neill, said, "Mike, it's not the chart that makes the stock go up 100%. It's the story." So yes, we sell on technicals, but we also are in Roku because we know the leadership characteristics that it's presenting from from the standpoint that people at home buying their smart TVs, they're now streaming. Roku is the operating system for most of those TVs, and they're making money selling ads to companies that are doing digital video advertising. So it's not the chart that makes the stock double, it's the story behind the chart. We demand that the chart support the story, but there's times that the chart doesn't, and then you got to get out of the way. Don't be a true believer and get sucked in.
You know, Twilio's got that kind of cult. I think Twilio's got some cult-like. I mean, Twilio's been a win. I mean, look at the stock. I mean, right? Why wouldn't you be a believer in Twilio? But it just pulls back to the mean here, and it's holding the mean. That's a victory for Twilio. But there's people become believers in the stocks that make them rich. You know, the stocks that your biggest winners. I can't begin to tell. Like my first 6-figure options trade. Danny, remember that? I came into your office. It was 2014. And the first stock I ever cleared 6 figures on, option wise, was Chipotle. And I went running into your office, and after that, I thought Chipotle is the goose that just keeps on giving, right? No, let me tell you, folks, Chipotle is an option premium suck. It is the worst. They are some of the worst options you can buy because Chipotle just. It's a low volume stock, Don, for a big, it's like a 500,000 share a day stock. And what happens is if you bought calls thinking Chipotle is going to make this big move, like it pulls back to the mean. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days of premium suck in options that are pretty pricey to begin with will crush you. And so, gosh, that was years ago, Danny, right after I met you. And that I can tell you, Tesla does this to people all day long. Look at Tesla, just coiling around the mean. You fall in love with it. I mean, Tesla's made so much money for so many people this year, and it's just coiling around the mean, and it's just sucking. And the options are so pricey, Don. I mean, the options are just ridiculously priced. I mean, you can still trade the 1600s today. Like, and it's trading what, 1460. That's how ridiculous Tesla is, and you can't fall in love with them. You just got to know, you have to have a signaling device when they're ready to go. And if you're an options trader, the easiest thing to do in something like this is if you don't have a crossover, like a moving average cross, like a 5 through an 8, a 21, an 8 through the 21, something like that, then you just buy the stock and it's a delta of 1. And if you don't trade options and none of that made sense, you're probably better off in the long run.
There are two real nice consolidations on that chart that resolved to the upside after pulling back to the mean, doing what Tesla's doing right now.
Yep. You're talking about this one right here?
Yeah, that's the first one, and you could even draw that back at about 5 more sessions, and that's the other one. Yeah.
Oh yeah. Well, there's one right here too, and so.
Yeah. Look, but if you're talking about length, I'm comparing the length of this one, which is about 10 days.
Yeah. And so I like Tesla to the upside. I think Tesla's going to have a huge move, but it's had such a huge move. I mean, this stock at the lows was around $400, $400 in the March lows. It's now $1,500. Some things are just going to be due for a break here. They're not going to run forever. Let's do this. I've got some 21 over 21 stuff I want to talk to you about, Don. I've got probably the most interesting question I've come across. That's going to really help stock nerds and market lovers as we move into the second half of this year trading wise. I think so. Let's do this. Let me get some admin stuff out of the way here real quickly, folks. Look, if you like the strategies to which we espouse, a couple of things. We want you to contact us. So look, if you have questions, I answer most of your questions on the video. Sometimes you don't even know I'm doing it. When I miss the questions in my email, I tell you I'm sorry. And like last night, I did an ATR question and after hours trading question. Just email me, tim@revereasset.com. Here's Don's email address, and there is America's Fiduciary. And I was saying in last night's video that Danny doesn't call us that much during the day because he's taking all of your calls. And it's a huge thank you. Like you trust us. And it doesn't matter what questions you're coming to us with, whether it's a pizza bowl question, a keto diet question, or more importantly, you're realizing that life insurance isn't an investment. It's insurance, or an annuity isn't an investment. It's insurance. And you don't know how you got hoodwinked on these products, but a slick salesperson did that to you. Danny is taking those calls. And whether you're going to become a client of the firm or not, the fact that we can help you or educate you is our mission. And if you want to become a client, we'd love it. If the stock nerds across the globe all became clients, we'd be tremendously huge. But we're here to help you, regardless if you become a client or not. Now, the easiest thing to do is call us. You can send an email, but sometimes emails are long. Your thought process doesn't hit your fingers all the way, and you leave big chunks out of the story, so it's hard for us to reply. So 855-732-5932 is how you get a hold of us. And it's so simple to just, we pick up the phones on the weekends. It's so simple, just ask your question. We'll never harass you. And then let me show you this up here. Daily Market Insight. There's 2 videos. You're watching the video podcast right now. But here, Don, Friday night, is going to have in there the 21 leading stocks for next week. You know, Don, I'm drawing. And I'm just going to stop right there because I realized how I was drawing that's not going to turn out well. Yep.
Good thinking, Tim.
Yep.
You want to draw an antelope or an ant or something? I know you're really exceptional at drawing animals with that marker.
Yeah, antelope's got like feet,
looks like a
right?
flying saucer.
Does it?
That's terrific.
That looks like a flying saucer.
See, this is why our podcast has become a video podcast, and you just don't get that out of an audio only sharing of information.
That's absolutely true. So Don's 21 over 21 list populates every Friday night, or usually every other Friday night. This is the rare 2 weeks in a row. That list is the Bible, man. I'm telling you, if you are like, how do you guys screen for your ideas? Don takes you through that in the 21 over 21 list. It's a tremendous asset, and we give it to you for free. You don't even have to register. If you don't want to have to think, did I get this week's watch list? Did I get the video podcast? Subscribe right here. We'll never spam you. We don't send out marketing. We don't have salespeople. Just subscribe, and every time we post a video, you'll get it. Podcast, if you on your favorite podcasting platform, if you find us at Your Money Radio, Google Play, Apple Podcast directory, you'll get it populated. You know the Daily Market Insights where we post everything as soon as it's done. And so, but if you subscribe, it'll come to your inbox. If you want to get it early and check if it didn't show up for some reason, go to Daily Market Insight. And look, we'd love it. Call us. We'd love to talk to traders and investors. So whether you understand what we're talking about, whether you disagree, it doesn't matter. Look, and we believe in, there's a big thing. You can tell the show is unscripted, so to speak, even though I've got a whole, this is how I plan the show. I just write down what I want to talk about.
We didn't hit any of
to the guys. Well, yeah, and because the best radio, the best conversations are organic, and you can see that we don't live in a like-minded bubble. And I'm telling you, living in that agreement bubble is really dangerous. If everyone's just nodding their heads and going, yeah, you're going to miss some of the best opportunities for critical thinking. And so, please, if you disagree with anything we're saying, we welcome it. Absolutely, and believe me, people do not agree with us that about my personal hatred for the insurance salespeople. Look, follow us on Twitter. This is the easiest thing you can do right here at TJ Razor. And the reason why I say that is you can message me. I don't give my phone number out anymore. You can message me And that's how I'm going to get back to you. And Twitter is brevity. So I'm at TJ Razor is how you get a hold of me. Let's see, Don is D Vandenbord. There he is. D Vandenbord. And if you do follow us on Twitter, like, well, I hate Twitter, Tim, that's fine. Just follow us. We'll give you a bunch of good content on Twitter, or you now have a direct messaging platform to us. And some of you might say, here's Danny, one Danny Stewart at D Vandenbord, at TJ Razor. And you might say, well, why do I need to follow you here on Twitter? What's the benefit to me? I get a ton of email, man, and I miss them. And I'm being honest with you. And some of you write volumes to me, and I appreciate it, but it takes a while to go through that. If you do it on Twitter, it's quick, it's brevity, it's limited characters. And so you get your thought, you express your thought out that much quicker. And so you'll get an answer that much quicker too. I just know that. So let's see. Don, let's do this. Can you tell me?
I'm also on Parler at D Vandenbord.
What is Parler?
Parler is where all the conservatives are going to go the next time Twitter censors Trump.
That's where Parler is a new platform?
Parler. It's the non.
Hold on, spell that one more time.
Parler. It's like Twitter Lite. Par. Parler. It's to speak in French. They actually was supposed to. It's actually supposed to be parlay, but we're stupid Americans, so we go phonetically and call it Parler.
You stupid American.
But that's where conservatives don't get censored for their free speech. That's where you can actually post some results about using hydroxychloroquine, zinc, and Z-Pak, and see that people are getting cured of COVID. So,
Don,
how much do you think Twitter stock would drop if Trump got off of Twitter? I know Tim's trying to change the subject, Dan, so we'll move on.
No. I want to engage with you here. You are on a mission today. Go ahead. You all right?
Yeah, I'm fine.
Well, the Parler doesn't censor anybody. Anybody can get on there. They'll just let you say whatever you want. They don't censor.
No, that's not totally true. There's no pedophilia on there.
Well, all right. With
can we just pause for a second? This is the first time in the history of a stock market show, any stock market show, even Fast Money, where they've mentioned the word pedophilia. Don, I want to just give you high praise for finding a way to work in the word pedophilia into a stock market show. Jesus.
It's what I'm here for.
By the way, that wasn't on my sheet.
Once again, reminding the show is really not that scripted.
None of that was on my sheet. Yeah, Don, a real hard stance there. Yeah, we're against pedophilia. I've pretty much had that my whole life. Didn't have to write that down. Good stuff. Did you want to hijack the show there?
You're welcome.
I got some downside alerts, Don, on pedophilia. You want to talk about those?
Well, Tim, there are actually some people that think that's a sexual orientation.
Oh God, even I'm figuring out, well, where do I go? Like the synapses in my brain, like one of them's like, if you remember the show Herman's Head, one of them they're just screaming on the left side going, what the hell? And then on the right side going, well, you can totally turn this topic into something interesting that reverts back to the stock market. And I'm not finding anything.
Yeah. I thought you were professional, Tim. I thought you were professional media.
We did it, Dan. We knocked him off his game. We knocked him off his game.
The topics I've got left.
I thought we were going to talk about bonds. No.
Yes, Danny. The transition from Don's topics to bonds is really a smooth one.
Well, yes, I know, but with that topic Don picked out, it's tough to transition. I don't know where you go from that.
I've also got a note here that's
switch gears.
I've also got a note here that says death by 4 or 5 sub-accounts, which I think is probably the jump I want to make.
Well, that's probably better. Yes. Okay.
Yeah. So literally the note I have here is death by 4 or 5 sub-accounts. So stock nerds. Boy, I need to turn off these. you know, this, can you see the Facebook notifications in my, on my screen? I got to turn those off. They're distracting me. But where did you guys go? There you are. But the first, if anyone on the show is seeing Facebook notifications, there is Don. I know where to go now. There's a barbecue group. Danny, you'll appreciate this. A barbecue group in Texas called the North Texas Barbecue Addicts on Facebook.
Oh,
okay.
Yeah. I've been a member
Do you know
for
that?
years. Yes.
Are you serious?
Well, you just now joining the group, Tim? Come on.
You learned about
hell,
parlay and the North Texas barbecue within 5 minutes, Dan. How about that?
Yeah.
Don, do you know that show on ESPN where they just put an X over? Hold on a second. They put an X over when you're not. They mute you. I forget what that show's called, but I'm doing that.
I try not to watch ESPN.
North Texas.
It's ridiculous. Social justice warrior bullshit.
You can't even mute him, Danny. He's got a burr on your saddle, and I want him to get it out. I feel like we're a therapy group for Don today, and if we don't let him get this out, his sister might be sick of listening to him. What does your mom call Tucker Carlson, your boyfriend?
My boyfriend. That was hilarious. 82 years old. She's walking with her cane from the kitchen to the living room. Oh, look, your boyfriend's on.
That's funny. That's funny.
I saw that.
She loves Tucker's hair.
I saw that.
That must be a very interesting household. You got
She said, "Oh, he's cute. I like his hair."
Tucker's got like a Danny Bonaducci 1970s haircut going on, right?
Danny Bonaducci. Oh.
I know who that is. That's Danny Partridge.
Yeah, Danny Partridge.
Yeah. He's a DJ now in LA, or was.
Moving on. This North Texas Barbecue Addicts group, dude, it is no matter where you're listening to us in the world, if you like barbecuing, smoking meat, they call it roll and smoke, grilling, this is the group for you. They are genuine. Like they're not gonna. You ask a basic question, you're gonna get like 600 genuine, nice replies. Like it is helpful. They're insightful. NTBA, North Texas Barbecue Addicts. They've got 60,000 members, Danny. It's craziness. And then like someone will ask, like they'll post a picture of some wood. Hey, I got this tree that just fell down. What is this wood? Someone from Australia goes, looks like cedar, mate. Don't smoke it.
Right.
Yeah, so great group. Anyway, I joined the group and I got the notifications that are coming in like wildfire right now. Death by
just like downside alerts.
Don, I swear to God, if I had a call sign to give you today, it might be downside alert. Like just watch. Hey, don't catch the falling knife that is Don today, because it's going to be like an Amtrak train running through Philly. Just get derailed. Too soon?
There's another downside alert. Zoom below 257.
What? Oh, zoomy zoom. I like zoomy zooms. Look at this.
That just means
here.
It broke to 21. Is seeing a lot of that in the last couple of days.
Yep.
A lot of breakage below the 21.
Interesting.
You know, if the stock's going to roll over, the first thing it's going to do is break the 21.
Yep. So a lot of you stock nerds, and we know this because you come. Danny knows this all the time. I learned through osmosis. So Danny talks to you, and you've got an account with Merrill, Raymond James, the aforementioned Wells Fargo, and I didn't know this till we started working together. But it's happening more and more. A number of you want to leave Merrill Lynch. Bank of America Merrill Lynch does this not exclusively, but especially. You don't understand.
CRA, there's lots of.
Oh, CREF is the new awful. And so CREF and Merrill Lynch in particular this week. Danny, explain to people what's going on when they have a retirement account at one of these places.
Well, what they'll do a lot of times, and it doesn't have to be an IRA, it can be an individual account. What they want to do is they want to break them up into sub accounts, so they'll have international equities or international exposure, and then they'll have bond exposure, and then they'll have US stock exposure. So they break them up into 5 different categories or 4 different categories. So if you ever were unhappy and you want to transfer out, you got to execute 5 transfer forms. So when the first one, they make it a lot more difficult to leave. And if you, as soon as the first one hits, they can call you up, browbeat you, try to salvage the account, try to save it. And really, you only need one account per strategy you might want to employ. So like with us, if you're doing protection stock and ETF, you only need 2. If you're only doing one strategy, you only need 1. You don't need 5 accounts per styling, per type of account.
It's when Danny mentioned this the first time, my first thought was, what do? Give steak knives to the salespeople? How many accounts can you get one client to have? But then when Danny explained it, it's so nefarious. You don't need, like Danny's saying, it's confusing to the individual investor. Why do I need one account for emerging markets? Why do I need another account for dividend plays? It can be 1 or 2 accounts. All it has to do is, it's so difficult to get your own money back from these places that every time you want to close one of those accounts, you can't, because they won't release the fund.
It's also tough to kind of put your overall performance together in one spot. And so they can, if they've got the US equities, they can kind of look at the S&P stuff. But then when the emerging markets are doing really poorly, they can go, ooh, this manager didn't perform very well. We need to switch them out, or we need to do this, or we need to take some emerging market money and put it in US equities because they're outperforming right now. Well, that's already happened. That's past. Right. Yeah, this should have been done beforehand, not after the fact.
And the common thread for every one of those sub accounts? No sell discipline.
Oh yeah, right.
Oh yeah, no, not Merrill Lynch, Edward Jones, Raymond James. What's that?
Well, I was going to ask you, Tim. I thought that was your place.
No, I'm in Nora's bedroom. She does
that
not live
was
here
my
yet.
Mom opening the door.
If your mom walked by right now and asked you how your boyfriend is,
I was about to say, tell her I said Tucker said hi.
Yeah, Tucker says hello. Had you down for a Waters World kind of guy, Don.
Oh, I love Jesse. He's going to be the next big star on Fox.
He's not now?
Oh God, Tim, please.
The main 3, when you've got your 1 hour show, those are the big 3.
Wait, we just mentioned 2. Who's the third?
Tucker, Hannity, and Laura Ingraham are the big 3.
Oh, I got you. Okay. Don, would you do me a favor real quick? Talk to me about the AAII study and the counterintuitiveness of it.
Yeah, the low
last week.
We've been, and I haven't seen the update for this week. The low put call ratio is normally a contrary bullish signal, but on the other hand, a very low bullish percent on AAII is also a contrary bullish signal. So we're getting mixed results from both of them. One saying low put call means, actually low put call is actually bearish. It means that there's not enough bulls. Low bullish percentage on AAII is bullish, means there's not enough bears. So even the secondary indicators are confused.
Yeah, that's 1,000%. And look, there's Don, even with even with the break of the Nasdaq stocks a little bit today, look at the advanced decline line over here to your left hand side. Really hasn't done any. I'm telling you, the easiest way to play the rotation into value stocks, I feel, is the indices, and that's the Dow and the Russell, and then the S&Ps.
I got the update. We rose. It's still only 23% bullish on AAII. The historical average is 38%.
And so what happens is they sit out. There's so much money on the sidelines, and eventually when that tide, like let's say it gets to 50, 75% bullishness, that's when it's probably late in the game, and everyone who's been making money on the way up now is starting to ebb out. They're coming in late to the game because they're now quote unquote bullish, and most likely you're due for a pause, if not a pullback or sell off, and that's what happens. And so this market is not easy. And so I know we're joking around a lot, but this market is very difficult to navigate because we have double-digit unemployment, even though the report was better than expected. And like if you look at a stock, like let's look BKNG. So here's Booking. They lost 91% of their business in the second quarter. 91%. They book things. 91% of those bookings went away, and the stock's up 0.4%. And it's just so, it doesn't make sense. But the report came in better than expected, which are some really confusing words. And it's not an easy market to navigate. And what we try to highlight every week for you stock nerds and market lovers are the tools that we use to form our global picture. Like so many macro people can't operate because the world is bad, right? Like what the world is bad. That's macro. The world is bad, but they don't have rules that get them into things. And that's why there's very few economists that can pick stocks. The things that make sense to them aren't what drive price. There's 7 common traits that typically drive price, and the market is the biggest factor of those 7 common traits. And we try to highlight those things every week to you. And so with that, Don, let's do this real quick. Danny, can you tell me the problem? Let's look at TLT right now. So what I want to highlight, there's an issue with inflation. So bonds are down today. Gold is down today, and a lot of you are going, well, with some of the stocks breaking, why isn't gold keep going higher? Why isn't gold higher today? And it has everything to do with inflation. And so if I put the TNX up here, the 10-year Treasury yield,
the rate,
the TNX is up 5%, almost 6% today. So I want people to understand this. This is the yield right now is 5.67, or excuse me, 56.7. You got to move the decimal point over. So earlier, like the yield was down at 0.50, 0.52, or 5 point. Gosh, Danny, I get myself all confused when I try talking about this out loud. 52.
A little over 0.5%. A little over 0.5%.
Yes, thank you. Thank you is what I'm trying to say. It's risen 6% today, which tells me that the dollar is going up today and bond prices are coming down, gold and silver are coming down. And you got to look at this chart. The 10-year Treasury index was stretched to the downside. And so when you're looking at this, like Danny and I have been trying to sneak into silver. We were going to do it the other day and we didn't, and that was kind of a missed opportunity, but that's fine. If yields just rebound towards the mean up here, like the zone of the mean, we're going to get our opportunity to sneak into silver because metal prices will keep coming down. But when you see the yields doing this, and you see bond prices in general doing this, that's inflation.
No, bond prices going down. Rates are rising.
Oh, thank you. Well, I meant, okay. Well, I meant when metals are going, I'm sorry, Danny. When metals are going higher and bond prices are going higher, that's inflationary. And and what's happening is that's affecting you stock nerds and market lovers every day, because every day that you go out and buy food or fuel or just anything in general, it costs more. And there comes a tipping point where inflation, and stocks can go up too. There comes a point where inflation isn't a good thing. And I want Danny to explain when that inflection point is, because he does it really well.
Well, so when you have bonds, when we're talking about bond prices, when interest rates start to rise, the bond prices will go down more disproportionately. They'll go down more at the beginning, and as rates start to get higher and higher, they'll go down. The bond prices will go down less and less. Conversely, when rates start to drop, the big pop in bond prices going up is is higher, and then so you've got diminishing returns basically. So here's what Tim is saying is with inflation right now, that's why gold and silver has been on a tear. Now today, you're getting a little bit of an uptick in interest rates because of inflationary fears. And it's not the Fed. The Fed is not trying to raise rates. It's the actual market. The market in treasuries is huge. It's by far the biggest market in the world. And investors are kind of backing off, whether they're assuming rates are going to go up and they're shorting bonds, or whether they're just booking some profits right now. So you really got to key off of that. You got to watch. Now, Tim said if interest rates come up to the mean, if that comes up to the mean, which is what, that 6.22, 0.62%.
Somewhere right here,
yeah. I mean, that doesn't sound like a lot, but that could be 4 or 5% on bond prices. That could have a big move. So and it could cause a short-term pullback in gold and silver. So if you're looking as an investor, if you're looking to get into gold and silver, you can afford to be a little patient and see how this plays out.
There's a big, the Fed wants inflation. They don't want deflation. And deflation's a really big, deflation is 70s talk, stagflation. You get these, what was it to buy a house in the late 70s, early 80s, Danny? What was the interest rate?
Oh, it got up to the double digits in the teens, high teens. Treasuries at one point got up to Treasuries at one point got up to like 18, 19%.
Yeah, I just refinanced at what, I had it at 2.85 on a 30-year. And if this, now these are historic in comparison, but if these rates start going higher, there's going to be, the Fed's playing a game here with rates, Danny, that
they're at a Hobson's choice right now because they can't really raise rates to kill inflation, because if they do, our deficits just balloon because there's so much debt and the interest rate rises. Now the government's got to pay more interest rates on the debt, but also if rates rise, you're going to slow down the economy. They don't want to do that. Here's the other thing though, if they pull money out behind the scenes, they pull out liquidity with the free reserves, all of a sudden that'll also cause rates to rise. But leverage works both ways. So when they drop rates, it'll give a little boost to the markets and it'll speed things up and it helps the markets. But when rates rise, it sells off. So compounding works in reverse. Compounding works both ways, both to the upside and the downside. This is why you got to pay very close attention to rates. Rates are important.
Rates are really important. So interest rates are rising today. So let's take a look at the housing trade that I've had on based on this TNX that I've outlined for a while now with you. So let's look at MTH down 1.4% today. DHI, DR Horton flat. How about Restoration Hardware? Well, that's having itself a day. So if those stocks start to falter, and you'll see it in price, and where you see the move first is price, and then the story will become rates are rising too quickly. But you'll see the housing stocks sell off first, the Home Depot sell off first. You'll see those things happen first. Then the news will get around, oh, this has been happening, and by then the market's already pulled back. And so pay attention to what's going on here. Or, oh, Don, what happened? I think Don just paused his screen. That's fine.
May have had a storm. There he is.
Oh, there he is. And so I thought I did it. That's why I was like, oh my gosh, did I just hit a button on Don? What the easiest thing to do is take a chart of ZB's 30-year treasuries, or take TLT. And you can just use the same probabilities that we've been talking about. And so look, you get close up to this third ATR on TLT the other day, and it pulls back. It doesn't pull back to the mean, but when you start getting up to this level, that third ATR, it becomes a bigger deal. And so when I was looking at the TNX with you just a second ago, what do you notice back in the beginning of June? That the yields, the TNX, had become really high, okay? And they started to reverse. And that would be your signal to then get into, and what date was that? That is the 5th
6/8,
and
yeah,
the 8th. Yep. And then look at TLT. We'll look at it on the same time frame. They bottom and they start making their move. And when yields started, now look at what S&Ps did. So we'll put SPX here. SPX, same thing. Yields started coming off. The market pulls back a little bit, stabilizes, and then it moves higher. And so you can use all this information to your advantage. But what do you notice about the SPX? Third ATR. And so if you don't understand and you're just like, you know what, I've got a grasp of what Danny was saying, how do I use that information to make myself money? Well, it's in your ether. You just keep working with it till it makes sense to you. And then you just look at these charts, and it's a probabilistic mindset. And I say probabilistic all the time because it's not an absolute. It's a market. Anything can happen. And so when you approach it that way, and then you apply probabilities to it, it gets, I think the life gets so much easier for you. And so hopefully that gives you some insight into how we think in the shop. Don, let's talk, Danny, let's do this. Let's do this. I want you to do the administrative stuff we normally do at the end of the show. I want to bring Don in to talk about 21 over 21, give him a sampling of that. And then I want to give a couple people some watchlist stocks that I've got working as well. So Danny, you're up.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor, just tell them to go to revereasset.com. They can sign up for our daily market insight. It's a short it's a subscribe button. It sends them, gives them our daily market insight short video newsletter for about 10 minutes every day. And they also get this podcast. And then to the right, you'll see the webinars. You sign up for the webinars, and you'll actually get Don's Lunch and Learn that he does once a month on a Wednesday at noon Eastern time. And it'll normally be on a specific topic on how to manage portfolios. There's a Q&A at the end, but even if you can't participate, they'll send you the link to the webinar so you can sign up. We won't spam you. We won't bother you. It's up to you to reach out to us if you want help. This is for your research and learning. You can also follow us. You can email any of us for questions, Dan at revereasset.com, Tim at revereasset, or Don at revereasset. You can follow us on Twitter at #1 Danny Stewart, at TJ Riazor, or at the Vandenbord. And you can always call us old school at 855 Real Wealth.
And then real quick, Stockner, so what a lot of you don't realize is if you pull up a video on Daily Market Insight, you can absolutely, you can download it. Like you can save every one of our videos. We never pull them down, but if you were to click the video, it gives you the option to actually download it. And if you want to save, we make all of our content available to you. You can share it to anyone you want. And there's a bunch of stock nerds and market lovers. What you do is you've been sending our content to the people you love, and they've been coming to us for help. And thank you for that. Keep doing that, please. Look, whether people become clients or not, the fact that we can help people means the world to us. Look, so many people want you to subscribe to things. That's not what we do. We want you to be able to take our information, help yourself, and if you need help, you'll come to us because you trust us, and the people that you love, you send to us. And so thank you so much for doing that. Don, let's do 21 over 21. Give me a sampling of what you're thinking, and then we'll, by the way, Don's 21 over 21 list is going to be in the Daily Market Insight tab starting Friday night. Go ahead, Don.
I'm seeing for the first time in a while some leaders really breaking down. There are going to be a few that are going to get punted off of the 21-21 list and need to be replaced this week. FSLY, which we've talked about, coming off the list, and then LVGO and TDOC. TDOC broke down. LVGO coming off because of the merger with TDOC. There are some other stocks that have come off in recent weeks off the 21 over 21 that have broken down even further. Vertex, Datadog, and Snapchat. A few weeks back, AYX also broke down. So we're seeing a little bit of a change in character in some of these leading stocks, and that's something you better pay attention to. I mean, I got easily 25 to 30 alerts while we were doing the show. It started around 11:50 a.m. Eastern time. I always look at what the SOX and the SAS stocks are doing. SOX is down 2%, IGV down 3%, CLOU down 4%. Rotation going on very clearly because the Dow is only down 0.4%. The S&P is down 0.4%. The NASDAQ 100 down 1.4%. So we started talking about the theme of small caps and the Dow leading over the last week, and that's following through today. Something else we're seeing is a contra rally in the dollar is up today, and that's probably why silver and gold stocks are down.
Yep. And so listen, like I have a bunch of stuff. I like Walmart. Walmart's portfolio holding for me. You can see it's pulled back to 21. Green on a red day is where I want to live. And so I've got some of these type of stocks in the portfolio. They're not always the most strong chart. They're not always the most exciting thing, but I want to be there. How about Chipotle? Down 1.1%. This is clearly, we've been in this for a while now, but I love this pattern that's forming here. I love looking at Chipotle right here. DPZ, here's DPZ. This isn't the best pattern, but I like Domino's, and it's just a steady, pull this to a weekly chart. That's a really beautiful weekly pattern. Daily pattern is not that exciting to me, but this pattern right here is a 1, 2, 3, 4, 5 week flat base. And I want to show you, where's my VIX chart at? I want to show you this chart. And so I've been talking about this on my videos. This is, you cross the 21, that's a purple line, SPX weekly chart. And this was a beautiful flat base that was forming. And we talked about it forever. But look, 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, 10 weeks. And now this week you broke out of the flat base. And from flat bases, or as I was highlighting last week, a 3 weeks tight. 3 weeks tight patterns, like this is a 3 weeks tight right here on the S&Ps. 3 weeks tight patterns are some of the most beautiful patterns in the world. It's my favorite pattern. I love the flat consolidated patterns. Out of all of them, 3 weeks tight. But it takes so much patience to do that, for traders to participate. But what I want to point out to you is this. So I'm looking at the VIX. So leaders are breaking down, and the VIX is still red. It's not signaling anything here. It's a difficult proposition to get excited about. Now it's flat. The VIX is flat, and so you know what you're seeing. Don said the key word here is rotation. And so you'll rotate out of some people are going to rotate out of some leaders. They'll find some new stocks. And for me, the easiest thing isn't to dig your heels in and buy the ones they're rotating out of. It's to wait for those setups. But we rotated into Russell and Dow. Is that a picture of the Pope behind you? Did I just notice that? We lost Don, but it was Danny. I think he had a picture of the Pope.
Well, he's Catholic, so I don't know.
Yeah, I didn't realize. I just noticed. I think that was
shiny.
We lost Don, but listen, he turned around and he saw the Pope, and then Don went blank. I think that was John Paul II. What were you saying, Danny?
I don't know how that happened. I turned around. Yeah, that is John Paul II.
Did you not know that picture of the Pope was behind you?
I did. I was just double checking. There's pictures.
It's been there for the last ever since he's been doing the podcast.
Yeah.
From that,
there's a lot of pictures all over the house, and I'm not. I grew up here, but the pictures change constantly, so I gotta reorient myself.
I mean, that's been there the whole time, and you must have moved your head. Surely I would have noticed John Paul in the.
It's been there the whole time for the last 4 or 5
really
shows.
Gosh, that is. I can't believe I missed that picture there. Well, kudos to you, Don. So anyway, that flat base is good. And look, some things are pulling back here. Let's take a look at some of the stocks that I do like that are pulling back. TSLA, we're doing this in real time, so let's see what Tesla's pulling back to. That's a bullish pattern. Like Tesla's down, that's not Tesla. I'm looking at Tesla here, and this is a flag pattern here on Tesla. That's interesting. Let's look at Zoom. That's a bullish chart on Zoom down to the 5. That's a selling wick. That was selling wick there the other day. That's Zoomy Zoom Zoom. And then let's look at one more here because DXCM, I talked about these in the video on Thursday night. See what Dexcom's doing. Green on a red day. So it'll be interesting to see how this day closes out, but it definitely getting some stop runs and some profit taking. So, but look, where you can find how this all works out. If you haven't seen Don's video, you want to go to Daily Market Insights and you want to look for something that has the words in it 21/21, and you will find how all this turned out and what we're looking for next week. Any last round or saved alibis, Danny?
I'm good. We'll talk to you next
Don,
week.
Yeah, you got anything else, Don?
No, Dan's good. So
we'll talk to you next week on Your Money.